Welcome back to the Deep Dive. If you're here, you're looking for the fastest route to high-impact, thoroughly sourced knowledge. We distill all that complexity down to actionable insight.
And today, we are charting a course right into the heart of the Nepali economy, specifically agribusiness logistics.
We're going to be deep diving into what our sources are calling the cold chain missing middle.
Right. And, that phrase, it sounds a bit academic, like something from an engineering textbook.
It does.
But in reality, it's a huge systemic failure. And more importantly, it's a massive, fundamentally overlooked business opportunity.
So we're really zooming in on this daily kind of silent economic hemorrhage that affects everyone, really, whether you're a farmer or you're a consumer in the city.
Exactly. I want you to picture this. A truck, right? It's heavily loaded. It leaves the fertile plains of the Terai, let's say from Joppa, a major vegetable region.
Okay.
And it's headed for the big, bustling, frankly, chaotic Kalamati wholesale market in Kathmandu.
That's a long trip, over 450 kilometers.
It is. It often takes days, navigating high heat, really poor road conditions. And here's the staggering reality. By the time that truck arrives, 20 to 30% of its fresh cargo, the fruits, the vegetables, is already unsellable. Or at the very least, it's severely downgraded.
30%, that's a 1 in 3 loss ratio?
It is.
So for every 4 tomatoes they load, one of them is basically just cash disappearing into the heat.
Exactly. And that colossal waste, it does two things. It depresses farmer incomes because they get less for their shipment, and it drives up prices for you, the urban consumer, because the supply of good stuff is artificially constrained.
It's just a tragic level of inefficiency.
It is. But here's the critical point from our sources. The prevailing narrative, the idea that we just need to build more big cold storage facilities, that is dangerously incomplete.
So it's not about hardware.
Not primarily. The real failure here, what we're going to prove, is in the business models, the flawed unit economics, and this debilitating information flow.
The demand is there, the produce is growing, the market is ready to pay. What's missing is the profitable, scalable service to connect the two. Okay, let's unpack this.
So the central finding, as you said, is that this missing middle is an economic problem, first and foremost, not an infrastructure gap.
And the core of that economic failure is aggregation.
Precisely. To get the economics, you have to look at the farm structure in the Terai. It's just so fragmented.
What do we mean by fragmented?
Well, the average farm is less than 1 hectare. So a really successful farmer doing a great job might produce, say, 500 kilos of cucumbers.
Which is great for them.
Excellent for a small landholder. But it's an insignificant volume for modern logistics.
And that's where the system breaks.
Yeah.
Because the workhorse for logistics is the 10-ton refrigerated truck, the reefer.
Right. And if you're operating that expensive asset, you can't profitably stop at 20 different spread out micro farms to fill it up.
The cost of that first mile collection, the fuel, the driver's time, all of it.
It just negates the entire value of having the refrigeration in the first place.
Yeah.
It makes way more sense for the truck operator to just pick up 10 tons from one central middleman.
Even if the produce has already started to degrade while it was sitting there waiting.
Exactly. They're optimizing for ease, not quality.
But wait a minute, if aggregation is the issue, shouldn't we just be, organizing farmers into bigger cooperatives? Is it really a technology problem or is it a coordination problem?
It's a bit of a feedback loop, but the current economics actually discourage that. Think about the second barrier, the unit economics of the cooling itself.
Okay.
So let's say the government or an NGO builds a massive centralized cold storage facility in a district town. Who is that facility really built for?
It's built for the bulk client, the big player moving 5-10 tons at once.
Exactly. For our farmer with 500 kilograms, the cost is just prohibitive. First, they have to pay to get their small load to the cold store.
Right.
Then they have to rent a pallet space, which is priced for high-volume users. The combined cost is often more than the extra money they'd make from preventing spoilage.
So the very solution that's supposed to help them, this big central facility, is actually locking them out.
It's a structural contradiction,
Yeah.
and it's all made worse by a total data vacuum. The farmer in Sarlihi has no real-time visibility into what the premium price in Kathmandu is. They're just relying on the word of a middleman.
And the premium buyers in the city, the big hotels or supermarkets, they can't reliably forecast supply from hundreds of tiny, unorganized farms.
So the whole system just defaults to moving bulk quantity as fast as possible. Quality isn't part of the equation. Spoilage is just treated as a cost of doing business.
So if that system is broken, where does the strategic money go? Our sources point to a really critical and actually counterintuitive strategic pivot.
That pivot is prioritizing mobile assets, these refrigerated trucks or reefers, over the static cold storage facilities.
Wait, so we've been building these huge, land-intensive cold stores for years, and that might have been the wrong approach. That feels
Yeah.
profoundly counterintuitive.
Well, think about it. Why is mobility fundamentally superior? A fixed cold store, say in a town like Itahari, is vulnerable.
How so?
If there's a local crop failure or a disease hits the tomatoes there or farmers just decide to grow something else next season, the utilization rate of that multi-core asset just plummets. It becomes a white elephant. The investment is fixed and it's high risk.
But a reefer truck, that's a mobile profit center. You can literally follow the harvest.
Precisely. You can send it to Bardibus when the mangoes are peaking. Then you can move it north to Elam for the kiwi harvest. Then west to Chitwan for specialty vegetables. You dramatically de-risk the investment.
And that flexibility, that mobility, is what enables this logistics as a service model, the loss model.
That is the strategic link. An entrepreneur doesn't just own a truck, they own a platform. They offer shared truck services, probably managed by a simple app on your phone.
Which democratizes the whole thing. The farmer doesn't need to buy a cooling system. That's a huge capital expense, CapEx. They just pay for the service. It becomes a manageable operating expense, or OpEx.
Right. A regional cooperative can just book 3 tons of space. They pay for what they use and share the ride with 2 other local groups.
And the simple tech, the booking app, GPS tracking, temperature sensors, that fills the information vacuum we talked about.
It does. And from an investor's point of view, the scale is so much more manageable. A 10 or 12-ton reefer costs, about 60 to 80 lakhs NPR?
Okay, so a tangible asset.
A tangible, scalable asset. Compare that to the multi-crore bureaucratic nightmare of building a fixed plant. You can start with 3 trucks, prove the model, and then scale up.
It lets Nepal basically leapfrog the old, inefficient infrastructure phase and go straight to a modern, flexible, service-based logistics network.
Which is where the developed world is heading anyway. So if that's how you unlock access, where does the real financial reward come from?
And that brings us to the crux of the investor thesis, the arbitrage of quality. This is where it gets really powerful. The opportunity isn't just about cutting that 30% loss down to 5%.
No, it's far bigger than that. The true economic prize is creating a fundamentally higher value product category.
Okay, define quality arbitrage.
It's the price difference you can command between a standard commodity and a certified premium product.
Let's visualize that. So the standard scenario, the produce from the Terai has that grueling 2-day unrefrigerated journey. It gets to Kalamati, it's bruised, it's softened.
It's often leaking. It has a shelf life of maybe 2 or 3 days max. It's chaotic.
Now contrast that, the cold chain-enabled path.
Okay, tomatoes are harvested. They are immediately pre-cooled at a small collection center, not a giant store. Then they're loaded onto a reefer kept at a steady 12 degrees Celsius.
And the truck doesn't even go to the chaotic wholesale market.
It bypasses it completely. It delivers directly to a premium buyer's distribution center.
We're talking about the big supermarket chains like Bhatpateni or major hotels that need strict quality control.
Exactly. And that tomato arrives firm, vibrant, undamaged, and, this is the key, it has a 7 to 10 day shelf life.
That's the value. For the buyer, that's consistency. It's less spoilage in their own inventory. It's a premium product.
And they will pay a substantial premium for it. Our sources estimate that this cold chain certified produce commands a 50 to 70% premium over the standard wholesale price.
50 to 70%.
That is the game changer.
Here's where it gets really interesting. Let's put numbers on that. If a standard kilo of tomatoes at wholesale gets, say, 40 NPR,
then a premium cold chain certified kilo can easily command 60 or 65 NPR when sold directly to that retailer.
so that's a 20 to 25 NPR uplift per kilogram.
Right. And that's pure value created by the logistics service.
Yeah.
On a full 10-ton truck, that's 10,000 kilos, you're talking about an additional 200,000 to 250,000 NPR in revenue per trip.
That extra revenue more than pays for the refrigerated transport and leaves a very healthy profit margin.
It does.
But hold on. If that margin is so good, 50, 70%, isn't it fragile? What stops a bunch of competitors from buying their own trucks and crashing that premium?
That's the crucial question for an investor. The competitive moat isn't just owning the hardware, the trucks. It's controlling the coordination,
It's service
the
like.
service layer. The barrier to entry is the ability to aggregate, produce reliably, and deliver it consistently at scale. The first company that integrates the fleet, the booking software, the pre-cooling, and the direct contracts with buyers in Kathmandu, they create an almost insurmountable advantage.
So the cold chain shifts from being a cost center,
Yeah.
something to mitigate loss.
To a service that actively creates a higher value product, it completely rewrites the profit equation for the whole value chain.
The path forward seems clear then, but it requires stakeholders, the government, investors, farmers, to choose which path to take.
Right. And there are two very different scenarios. The first is the status quo, which is, well, it's a continued tragedy.
Investment stays fragmented, the government keeps funding isolated cold stores that don't get used properly, and losses stay high.
And we continue this tragic irony of Nepal, a fertile agricultural nation, importing huge amounts of premium fruits and vegetables from India just to satisfy its own urban demand.
So what's the other scenario? The strategic one.
That one is driven by a new type of company, the logistics-centric aggregator. This company owns the supply chain, not the land. They use simple mobile apps for booking. They focus religiously on that quality arbitrage model we just talked about.
And they forge direct supply contracts with the big retailers in Kathmandu. They become the indispensable link.
Creating an immense competitive moat. And to get there faster, you need a little push, a surgical policy intervention.
And the most effective one our sources identified is very targeted. It's about amending the Vehicle and Transport Management Act.
Specifically, creating a distinct tax classification for agricultural refrigerated transport.
So like a tax break.
A substantial one. A 20 to 25% tax rebate on importing new reefer units and their parts. That dramatically lowers the initial capex barrier for those logistics entrepreneurs.
So instead of the state pouring money into giant fixed buildings that don't solve the core problem.
It deploys capital to catalyze the private sector to adopt the service model. It makes those 60-80 lakh investments cheaper, encouraging a scalable increase in the refrigerated fleet almost overnight.
So if we connect this to the bigger picture, it's about using state power to make the essential mobile infrastructure more affordable and widely adopted.
Creating a competitive, quality-focused logistics network.
This has been a fascinating deep dive. It really reveals how getting a tomato from a farm to a market isn't just a logistics problem. It's a deeply complex economic challenge.
And we've seen the path from fragmentation and spoilage to a future defined by mobility, service, and the profitability of quality. The financial case is overwhelming.
But our sources leave us with one final hard truth to think about. The ultimate bottleneck here. It isn't technology, and it isn't even just a lack of capital.
It's ultimately a mindset problem.
A mindset problem.
The real challenge is transitioning from a highly fragmented, individualistic agricultural mentality, where every farmer is an island, to a collaborative, quality-focused ecosystem built on trust.
Trust in the data, trust in the service provider, trust in the system.
Exactly. And it requires those entrepreneurs, the new aggregators, to uphold service quality as their absolute core value.
The challenge for investors, then, is to see that they aren't just backing a trucking company. They're backing a systemic shift in how the nation's most important industry operates.
So what does this all mean?
I mean, the first company that cracks this code, the aggregation and the quality logistics in that crucial Terai-Kathmandu corridor, they won't just be running a successful fleet of trucks.
They'll be operating the new backbone of the entire national agribusiness economy.
So the real question for investors and for policymakers is this. Are you prepared to recognize and back that indispensable service-driven link in what could be Nepal's next great business success story?